Hey, what's up, my friend? So, in today's video, I want to talk about a video that I've actually published a few weeks back. It's called This Simple Trading Strategy has a 88.89% winning rate. Okay, so if you have not watched that video, right, I'll put the link below so you can watch it first before watching this video because this is kind of like a follow-up to that previous video. Okay, and the reason why I'm doing a follow-up video, something that I rarely do, is because there's a lot of a feedback, engagement, and critique, right, to that video. So I want to, address that. So here are some of the feedback that I've gotten, right? Some of them says that, or rather a number of them says that, the number of trading opportunities for that particular system is too little. Some asking about, where do you exit your trade? Some says the system is too risky for small account and stuff like that. And I want to, take the time and to answer these concerns that you might have. Okay, so if you have not watched that video yet, right, in essence, that trading system, right, is a mean reversion trading system for the stock markets, right? In essence, you're looking to identify the stock market which is in an uptrend, to buy the dip and sell the rally. Again, the exact rules is in the video that I've shared with you earlier, the thumbnail. I'll put a link below this video so you can watch it if you have not. But first, right, let's talk about the issue, right, with low frequency of trade. So Jonathan here mentioned that it's not a bad strategy, but let me describe the flaws with it. Then he says that's about 30 trades, about 1.5 trades per year, and basically saying that it's better to just invest in the US stock markets. I think a buy and hold, higher returns, and don't have to do any work. Okay, then again, Sonny, similar feedback. Basically, after taking account inflation, there's not much left, right, for this strategy. Or from this person here, Vendra Singh, right? Basically, again, same thing, right? Low trading opportunities. And if you look at the video that I shared, right, towards the end of it, I actually mentioned that, and actually I also agreed, right, that the system has low frequency of trades. And what I suggested is to trade individual stocks for more trading opportunities. So I am not sure if many traders miss this point, or they choose not to see it, or they genuinely miss that point. But I put it out in that slide. You can go and watch that video, and I put it out for you all to see, is that you can trade individual stocks for more opportunities. Okay, so just because a trading strategy or system doesn't offer too many trading opportunities doesn't mean that it's useless. Here's why. So imagine this, right? Imagine that you live in this pretty secluded area, right, somewhere in the world, with only, let's say, 500 people living in your hometown. And in this hometown, right, you manage to grow your own coffee bean. You set up your own little mini cafe, and it's attracting a lot of crowd in your hometown, right? People love the coffee, they love the ambience, they love your service in this hometown. And you think to yourself, yes, it does make money, but you realize that you can't really make much money from this system and concept that you've developed, right? Because your hometown only has 500 people. So what do? Well, there are two ways to look at it. Number one, you might think that this isn't a worthwhile business to run. I'll just fold it up because it's nowhere as profitable, right, as because your hometown is only 500 people. Or you can think to yourself, this concept is clearly working. People love the coffee, they love the ambience, they love the settings. What I could do is maybe take this concept and this system into other parts of the world, to the US, to India, to China, and see how it works, right? To scale up and see whether we can make money overseas. So this is the same as trading, right? If you have a trading system that offers few trading opportunities, it doesn't mean the system is useless, or doesn't mean that you shouldn't trade it. You should take that system and trade other markets and see if it works as well. Because if it does, then that's where you get your money making opportunities. So in the previous video, I mentioned, right, to consider trading stocks, and I'm going to share with you the results, right, of what happens when you take that trading system, right, that concept, and you apply it to the stock markets. Right. In fact, this one is to the Russell 1000 stocks. So again, the concept here is the same, right? We are identifying stocks in an uptrend, waiting for a pullback, buy the pullback, and sell the rally. So you can see that when you apply it to the individual stocks, right, stocks in the Russell 1000, now your annual return is about almost 15%. This is the results, right, over the last, I would say, from 2000 to 2019, right? This is the year-on-year breakdown of the results. You can see that your drawdown over this period is about 31% over this period as well. So you can look at this, and now if you want to compare this to a buy and hold, obviously this one involves a lot more work, but at the same time you increase your overall returns and you reduce your max drawdown. With the buy and hold approach, right, your max drawdown, right, from 2000 is anywhere from 50 or 60%, especially after the 08 financial crisis. For this particular system, right, about 31% max drawdown. Okay, so again, this system doesn't make money every single day, week or month. You will have losing period, but in the long run, it makes money. And whether 15% a year, whether it's worthwhile to you, only you can decide. And by the way, this is only for the Russell 1000? What if you apply to the S&P 500? What if you apply to other ETFs, right, that track the stock markets? What if you do it on a weekly time frame? How will your results fare? Again, I'm not going to spoon feed you. I want you to figure it out and decide for yourself. But the key thing that I want to share over here is that just because a system has low frequency of trades doesn't mean that it's useless and doesn't mean that you shouldn't trade it. You should take that concept, that system, and apply it to other markets and see, right, whether you can make money out of it. Okay? So onward. Next one. What was your stop loss? Where do you exit? So this system is different from my other videos where, usually when I talk about stop loss, it's like, a fixed stop loss, like, let's say 100 pips above resistance and stuff like that. This stop loss is a time stop. So the first part of the exit, basically exiting your winning trade, is quite straightforward. You exit when the 10-period RSI crosses above 40, right? And this part over here is where is the exit, right, if you are wrong, otherwise known as your stop loss. So this is a time stop. So you only exit your trade after 10 trading days. So there's no fixed level on the chart where you will manually get out of the trade. You only exit it after 10 trading days. So after 10 trading days, if the market, the 10-period RSI did not cross above 40, then you will manually exit the trade after 10 trading days, which is, in other words, on the open, right, of the 11th trading day. And at this point, some of you might be wondering, hey, Rayner, if you exit your trade based on time, right, then won't you have the risk of, blowing up your entire trading account? Now, get this, right, this particular system, there is no leverage involved. So nowhere, right, would you have seen me say, oh, you got to use leverage. In fact, I didn't mention the word leverage at all. So if you were to trade this system using cash, right, it's unlikely that you'll blow up your trading account because it's unlikely the S&P futures will go to zero. I won't say that it's impossible, but I would say it's unlikely. And again, if you trade stocks, let's say the S&P 500 stocks, but you trade 10 of those stocks for your portfolio, for that account of yours to go to zero, you need all 10 stocks in the S&P 500 to go to zero. Now, again, what are the odds of some of the biggest stocks in the US, the 10 stocks that you buy, going down to zero? Again, possible, but unlikely. So that's pretty much the exit, right? We use a time stop instead of our traditional stop loss. Next one, right? I tested this in a few places, including the S&P with exact parameters. I found many times the price to continue to dip a lot lower, okay? And basically, people with small accounts could easily get stopped out and lose a lot of money following this. And this, I agree, right? People with small account, there are limitations, right, to what you can trade. For example, if you have a small account, right, you want to avoid trading stocks or futures. Why is that? And the reason is simple, because a small percentage move in these instruments could wipe out a huge chunk of your capital. For example, let's say if you have a $500 account and you trade one contract of the S&P futures. I'm not sure whether you can, but let's say you can, right? A small percentage decline in the S&P futures could actually easily wipe out your $500 because that's a leveraged instrument, okay? So if you have a small account, right, again, you have limitations, right, to the type of strategies that you can trade and the instruments that you can trade. So my suggestion is that if you have a small account, number one is to, grow the size of your trading account, maybe through savings. Or number two, consider trading the FX markets where you can trade nano lots, micro lots, right? Where, you can really better manage your risk because they allow you to buy, fractional size in the FX markets. Otherwise, right, you want to be aware of your limitations because of having a small account. So this statement here, it's valid, right? But it's not because of the strategy. It's not because the strategy doesn't work, but rather it's more of a function of, having a small account that comes with the limitations of having a small account. Okay, and next thing I want to point out and talk about is also a concept, right, from the video is to avoid shorting stocks after a strong down move. So as you have seen, right, stock markets in the long run, they are in an uptrend. So what this means, right, is that whenever there's a pullback in the stock markets, more often than not, that pullback will end and stocks will continue higher. That's the nature of the US stock markets. If you look at the chart of, the US S&P 500, the Russell 3000 or whatever, since its inception to now, right, it's in a long-term uptrend. So this should signal to you that if you are trading stocks, you want to focus on buying stocks and avoid shorting stocks. Yes, you can short stocks, right, but don't do it, especially, right, after the stock market has declined for a few days or few weeks in a row, because this is where a rebound, right, is likely to happen. In fact, if you are new to trading, I wouldn't even recommend you shorting stocks because, as you have seen, in the long run, stock markets is in a long-term uptrend. I can actually just use this chart, obviously a cherry-pick chart, right, to illustrate my point. So you just zoom out and you can see the number of times when there's a pullback, there's a pullback, there's a pullback. What usually happens? Well, pullback ends, market continue higher. So you can see that the path of least resistance when trading the stock markets is towards the long side, not the short side. And when you are, looking at the chart, oh, the market is so bearish, right? Recession, market is going to collapse. That's usually when the rebound, right, will really hurt even more. Okay, and the final point that I want to bring across is to do the work. So when I made that video, right, that video wasn't meant to spoon feed you with strategies, techniques for you to copy and paste. It's to actually make you think deeper, take the concepts that I've shared and validate and verify it for yourself. Because that's the only way, right, you will find trading success. You can't find trading success based on just copying the work of others. It doesn't work that way. You have to validate the concepts, the ideas, the strategies, and see whether it work or not. Because only by doing the work, by doing the verification, the validation, the validation, will you have the confidence to trade the strategy. So I would say, disappointed that I didn't see too many traders, right, showing signs of them doing the work. The only one that I come across was this person here, this island trader who actually, signals to me, man, this guy, clearly, right, is someone who is willing to do the work. So really, you must do the work, right? I know I sound like, your parents when you're young, oh, hey, you should be studying hard, right? You want to get a good grade so you can go out there, and join the workforce and, you have a better quality of life. That's what my parents used to say, right, when I was young, and I hated it. Okay, but thinking back right now, it's meant for your own good, right? By nagging at me to study hard, blah, 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 they just have the best interest at my heart. And whether I study hard or not, it's not going to impact them one bit. And I totally get it. It's the same as me right now telling you to do the work, to, validate the concepts out there. Do the work, right? It's not going to impact me one bit whether you do the work or not, but it's for your own good. If you do the work, you find success, congratulations, right? I'm pretty sure you're not going to send me money my way, okay? So do the work, because whether you do the work or not, YouTube is going to pay me ads anyway, right? But it's for your own good to do the work. I'm just being honest down here. Do the work, it's for your own good. Okay, so with that said, I've come to the end of today's video. I wish you good luck and good trading. Do the work, and I will talk to you soon.